Hey, Rand, welcome to the podcast. How are you?
Yeah, good, Alan. Thank you for having me.
It's my pleasure. Now, just quickly, we had a bit of fun and games with the time zones, working out the best time to speak. So you're not local to me. Where are you speaking to us from today?
I am in Seattle, Washington, where the fog is just burning off from a very cold evening. And I see a little sun poking through.
Wow, that's exciting. Yeah, I get the impression, I've never been to Seattle. The weather can be similar to the weather we get here over in Europe and in London. It's you have nice days and sunny days, but it does get a bit sort of damp and dark from time to time.
Of major U.S. cities, we have the most days with rain.
Right. Okay. But you're enjoying yourself nevertheless. Now, I want to just. I've been following you for quite some time, and in fact, we spoke, or we had a sort of email exchange sometime last year, and I wanted to, get you on the podcast and share some of your thoughts and experiences. You weren't ready at the time because of a number of different things that were going on, which we'll probably talk a little bit about later today. But the first thing I want to talk about is your book, and I know it's been out for a few years, but to my shame, I've only relatively recently read it. The book's called Lost and Founder: a painfully honest field guide to the startup world. And I read that book. I was going to say I read it in one sitting. I actually read it in two sittings. The reason it took me two sittings was because I just kept stopping to highlight and take notes. There was just so many lessons. Honestly, not just saying it because we're speaking here now, but it's one of the best books I've ever read about, entrepreneurship and business building. It's fabulous. And before we go any further, I will just to say to anyone listening to this, you must read it. You must get it. If you're in business or you're an aspiring entrepreneur, it's fabulous. Now, what is interesting to me, though, is that the majority of the story in that book is around your time at a business called Moz. Yeah. And to bring things bang up to date, because the book's been out for a few years, you're no longer at Moz. And we're going to talk a little bit about, what happened and where you are now. And I think the best way of doing this, if it's okay with you, Rand, is let's start where you are today, and then we'll maybe sort of work our way back somewhat. So tell me about your business currently, because you've got a new startup right now. So tell us what's that called and tell us all about it.
Sure. Yeah. So funny enough, Alan, I actually run two businesses right now.
Right.
One of them is still in stealth mode. That's an indie video game development studio with a few folks actually in Europe, in your neck of the woods, and sort of a co-author project with my wife, Geraldine. That business is called Snack Bar Studio, should have a website and a launch up in a little while. But the primary business that I run for most of my time is called SparkToro. SparkToro, similar to Moz, is in the marketing space. It's marketing software, but it is not SEO, which is what Moz did. SparkToro specifically helps with audience research. So understanding groups of people's behaviors and demographics on the web, what they do, what they visit, what podcasts they listen to, what YouTube channels they subscribe to, what subreddits they follow, what social accounts they follow, what websites, all that kind of stuff. And that helps a lot of marketers, mostly in the SMB space and agencies and consultants. I don't know if you're this way too, Alan. I often find that folks I resonate with are, I hate Starbucks. I don't like Walmart. I'm not an Amazon fan. I don't like big companies, and I'm not particularly excited about serving them, but I love small businesses. All my critiques of capitalism are not necessarily applicable to the small business world. And I love little companies and startups. And so SparkToro is really designed to help those kinds of folks. It's a tiny company. We ourselves are just three people. It's myself, my co-founder, Casey, and Amanda Natividad, who's our VP of marketing. And the three of us run a very chill business, aiming for between 20 and 30 hours of sort of required work most weeks. Some weeks, weeks we're 40, 50 even.
Right.
But most of the time, our goal is French working hours or less.
Okay. Yes, our French listeners will appreciate that comment. But so that's a great place to start right at the beginning, because that is in direct contrast to what is generically known as kind of the hustle culture. Let's just, that's nuts. You should be working 20 hours a day, never mind a week, is the kind of, you follow some of the narrative you see on Twitter and on even LinkedIn and things is crazy. So I'm guessing this is quite a different approach to the approach you had at Moz. Moz was a sort of a much more of a hustle culture type business, was it? People really grafting, putting the work in. So, I
Yeah,
mean,
absolutely.
but tell me more about that. What sort of transformed? What was your thinking between the two modes of operation?
Yeah, I think this goes back to business design, and any entrepreneur, in my opinion, should be thinking very hard about the design of their business, similarly to how they think about the design of their product or the design of their marketing campaigns or the design of their sales strategy. It's just the business philosophy and structure that dictates so much of what your life is going to be and what the lives of your employees are going to be. So Moz, for folks who don't know, was venture backed. It started as a SEO consulting service. We built some software that then raised some money. I was made the CEO, and we had a formal board of directors. We raised a few more rounds of funding over the next few years, and Moz grew very fast. It rode the wave of kind of Google's growth, right, to become the dominant web search engine, and then, of course, to sort of take over the world with search as the primary form of navigation for the internet. Mm-hmm. And that wave was very, very good to that company for a lot of years. So, as CEO, is kind of 100% year over year growth, year after year after year. I think 7 or 8 years in a row. Wow. In 2014, I stepped down from the CEO position at Moz and promoted my longtime chief operating officer to that role. I was going through a deep depression and having a lot of mental and emotional challenges. Mm-hmm. And I think a big part of that was driven by what I now recognize as, at least in some combination, burnout. Yeah. Right? Just too many hours focused on working hard and trying to maximize my output as opposed to getting good sleep, getting good rest, being a fulfilled person, having a good life, and being able to make excellent decisions based on that. And so this is the philosophical piece.
Yeah.
When I started SparkToro, I had these years of history knowing that I had made poor decisions due to this hustle culture and wanting to build a business whose success was not based on how many hours I can physically put into it or how many anybody else can, but on the quality of the decisions we made about what to do and what not to do. And that is something I'm sad to say very few entrepreneurs, even those who are not necessarily pro hustle culture, consider, right? How do I design a business where high quality decision making drives the results rather than hours worked by me or anybody else in the business?
See, I find that so interesting right from the get-go, because it's quite profound, because it's so opposed not just to business but kind of to human beings almost to some extent, because we're always, whether it's exercise or work or family, being active, being busy, hustling, moving, doing something seems to be is what society respects and rewards. And I've just been reflecting on this myself recently, in that my best work is done when I'm thinking. There's a lot of deep, good quality thinking is required, and you're not thinking when you're in front of a computer screen or you're taking a phone call or something. But it kind of goes against the grain for me. I think, well, I'm just going to sit or go for a walk and sit on a park bench and stare into space, and everyone thinks I'm some sort of freak. But you think, no, you're doing good. You're doing good work. Yeah,
this is the beautiful thing, Alan. I have often found, and I think lots of researchers, right, who look into how human beings make good decisions and how they perform on, for example, exams or writing essays or those kinds of things, right? They look at behaviors that predict better and worse results from the same individuals. Right. And one of the things that is consistently found is that your brain works in the background. Yeah. And you don't have to be conscious of it. So you can say, gosh, I'll give you an example. So SparkToro, our primary product and relies on Twitter, well, historically relied on Twitter as a connector network to sort of connect up all the profiles that we index and then get all the behaviors and demographics, right? So even though we have data from Facebook or LinkedIn or Reddit or YouTube or whatever, Twitter was the connector between those because many people's Twitter profiles would link off to these places. So great. It was working great for, a good few years, 2018, 19, 20, rocking.
Yeah.
Then this insane billionaire decides that he wants to buy it on a lark. Then he decides he doesn't want to buy it. I could tell you a whole story about how he contacted us to try and get us to get him out of the deal.
Okay.
Got a really weird text message. It was like, that can't be Elon Musk. Oh shit, it really is.
Wow. Okay. That's another podcast, but yeah. Okay.
Yeah. I'll put that in the second book.
Yeah.
But, he buys this network and then he just does, crazy stuff. Essentially, he wants to turn it into a kind of right-wing hate platform for himself and his opinions, which is whatever, right? You can do that, I guess, if you have money. But unfortunately, it also shuts down a lot of the value that we get from this network. And so I was actually on vacation in Oaxaca, Mexico, with some friends in January when this happened. Casey and I, get on a call from a weird gas station kind of between Oaxaca City, de Juarez, and this middle of nowhere place that we're going. And I just remember sitting out there in the, Oaxacan desert thinking, oh man, this beautiful business that we're building, it's kind of over. Like it's done for, we're just, I don't know what we're going to do. And over the next few months, what happened for both Casey and I was that rather than pull all-nighters and try and work ourselves to the bone to come up with a solution, we instead spent a lot of healthy time away from the business, right? So relaxing, taking it easy, being chill, recognizing that, hey, we have this wonderful, very profitable thing. We only have 3 employees. Our costs are low. We're actually about to repay our investors. We've got this model that doesn't need us to grow every month. If we have 6 months where the business shrinks, that's going to be fine. Honestly, it's not going to kill us. We have a lot of data that will continue to be useful to people for a long period of time. So we really took it chill. I would say, we encountered some frustrations, of course, as you do.
Sure.
And Casey put in some healthy hours for sure, trying to investigate new data sources. But what really helped was going to an art museum, sitting around, playing video games for a few hours in the middle of the day. Going on walks. And in the back of your brain, you are processing the problem that's not occupying the front. And sure enough, we came up with some really great ideas, some of which have now been implemented. We've been able to buy some data from other sources, find some other places. The new data set is very clickstream, LinkedIn, web-based. And, we've done some customer research. We're pretty excited about this new version thing. But hey, I think what the lesson from this is in my Moz days, I would have just crunched.
Yeah.
I would have crunched, and I surely would have been burnt out, stressed out, mentally wrecked.
Probably capable of making not as good decisions. Your decisions might not have been as strong or thoughtful or reflective, but that you almost feel compelled. I've got to come up with something quickly. It's like brain, quick, think, instead of just relaxing.
Speed is actually, I think, one of the biggest myths of the venture world, right? So because a venture-backed company like Moz was not just looking for kind of growth at all costs, but growth at all costs as fast as possible or die trying. Yeah. And die trying is actually very acceptable in the venture-backed world. Yeah. 95% of venture-backed companies aren't going to last 10 years. Yeah. I think less than 15% even last 5 years. Wow. So very, very, small set are making all the returns. And so your investors are very comfortable sending you on a kind of or supporting and amplifying and pushing you, nudging you towards a journey that is burn out fast or become monopoly in your space.
Yeah. And what I found fascinating from the book was really understanding from the business, from the entrepreneur's end, the kind of the involvement of investors and VC investors. And, I've seen it from the other side in terms of, I follow these people online, I listen to podcasts and things. It sounds very glamorous. It does. The VC world, we've got all these startups. We know some of them, 1 in 10 is going to be the unicorn and all that sort of stuff.
1 in 100.
1 in 100 or whatever, there's very few even survive, but it sounds quite interesting and glamorous. And you read it from the guy who had the business. It got, you raised capital. Tell us about that story, because I know, and I'm really interested in how you're running SparkToro now from a kind of financing viewpoint.
Oh, sure.
Because you were a kind of classical sort of digital marketing business that raised finance from VCs, from investors. And would it be fair to say you wouldn't encourage other entrepreneurs to go down that route? Most of them now?
Yeah, I think most of them. The story that I would tell is actually not dissimilar to what I hear from most VCs. When they get on stages or when they're interviewed, they say VC is wrong for 95% of companies.
Right.
And they're absolutely correct. The problem is that it's marketed to 100% of entrepreneurs.
Right.
And it's marketed in a particular way that I despise. And that I don't know that there's any one venture capital partner who's responsible for this. I think it's sort of a cultural problem and challenge, but there is a strong incentive from VCs to sort of pat entrepreneurs like me on the head and say, oh, what an adorable little $1 million business, $2 million business, whatever you've got. Like, if you ever decide to join the big boys, give me a call.
Yeah.
And the idea is to make you feel bad by pejoratively using the term lifestyle business, right? Yeah. Oh, it's so cute what you're building. Maybe you'll get to $10 million, but that's not serious. And I'm going to tell you right now, Alan, so many of my entrepreneur friends who started agencies, consulting groups, product businesses, who did not raise venture, were shocked when we would hang out and talk finances, and they would learn that their salaries were bigger than mine, that they made more from their companies than I made as CEO and largest shareholder of Moz.
That was a big reveal again to me in the book, because again, one assumes this guy, all these grand words. He's a tech founder, he's a startup entrepreneur, he's got VC money. He must be rich. He must be rich. Again, must say you were extremely candid. You actually break down how much you were earning specifically, in dollar terms, and tracked it. Had you just, I don't know, joined a bigger company and got paid as a salary, and the numbers weren't much different. And then you trade off, as you say, and I think this is what's particularly fascinating. There's a lot of different moving parts in this conversation, and it's kind of the stress levels and the work hours. If you pay a premium for those, to most people, it's just not worth it. Sure, if you do exit at $1 billion valuation and something, you think, how it's like winning the jackpot, winning the lottery. It was worth all those sort of all night, and maybe not, because as you've already alluded to, that the health issue. Because, as a founder, you can't escape from it. You are always, even when you're on your sort of walking in Mexico, you're still thinking about business. That's the thing. So it's with you 24/7. And I'm guessing if you got the external pressure of outside investors, and I got the impression that your investors would, compared to most others, were pretty decent overall.
I really think highly of them, even now, right? I have lots of frustrations, and there's decisions that they made, especially after I was no longer CEO, that I don't understand, and I've never been able to understand. But I think they are some of the better folks in that field, right? Their behaviors are good. I'm not aware of any, Me Too type of stuff, which unfortunately is true for a lot of venture capital investors. I think that is one of the reasons that the field is so extremely unfriendly to women. I think women have raised 1/20th of what men.
It's tiny.
It's
tiny, the numbers, and yet the results for women entrepreneurs are actually far better.
That's right. So statistically speaking, if you were to over the last 20 years have backed only women founded or women led venture invested companies, you would have vastly outperformed all your peers in the market. So it's very strange, right? They like to pretend that they're statistically minded, but clearly not.
Not always.
And I would say on the financial side, one of the things I was actually just speaking about this with with someone who runs a fund, the Tiny Seed Fund, which actually Geraldine and I, my wife and I, are investors in. They use a model similar to SparkToro rather than similar to venture capitalists. And I was talking to them about the idea of bootstrapping versus building a venture-backed business. And I think this is also a fundamental problem for many entrepreneurs and even many folks who join a startup, is that those are seen as the two options. And I think that's terrible. Because bootstrapping is simply not possible for a business that requires even mild amounts of capital to get going, right? I guess you could debt finance, or you have to have rich family.
Sure.
That you can fall back on, but that is just not an option for the vast majority of entrepreneurs. And so I'm loath to recommend it. Similarly, venture, the overwhelming majority of venture goes to entrepreneurs who already come from wealthy backgrounds. So it's, something like 85% of capital goes to founders whose parents are millionaires or greater. So really frustrating to have nothing in the middle. And that's what I'm hoping to create with SparkToro. So our funding structure raised money from a lot of folks like yourself, actually, Alan. Okay. So 35 angel investors, many of them who ran digital agencies or, have content networks that they run, or were entrepreneurs that I knew from the Seattle world. These 35 folks all put in between $25,000 and $100,000 each. They invested in 2018, and earlier this year in 2023, they all got their money back when we basically made enough in profit to rebuild the capital that we had used to build the business. We raised 1.3 million. We spent down to around 400,000 in the bank, and then we made back up the 900K, and we repaid everyone. We continue to have about $500,000 in the bank, so we're nicely liquid if we need to support a few months of unprofitability. But we're in this great position where now our investors are going to make profits through dividends every year that we pay them out. So my plan, my hope is that 5-10 years from now, our investors look and they go, "Oh my God, I got a 4x investment, four times my money return from SparkToro, and I still own all my shares."
Right. Okay.
That is a model that I think can work because it allows investors to have a much lower risk profile. They know they're going to get paid back before sort of you do, and you don't need an exit. Right? The company doesn't have to sell to somebody.
Exactly.
It doesn't have to grow particularly fast. All it has to do is get to profitability and stay there, stay alive for a long time.
Yeah, really interesting, because it's what's also required is patience, which you don't have. The thing about that, and I knew about this anyway, but you really explained it really well in the book. It's really just kind of the VC model. Again, it's not their money anyway. They've raised money from other organizations, from wealth funds and family offices and foundations, etc. And it's generally there's a relatively short-term cycle, and they need to be, you need to grow fast or get out quickly, because they're going to need to return money to their investors. So the intensity and the pressure is just part of the system. It is what it is, and most of us, you might not know that until you're part of it, and then you've been sort of cold at midnight about your numbers aren't sort of stacking up this quarter, so you need to do better next quarter. So but this sounds like it's kind of, if you like, a gentler, it's a slower model, and you're not necessarily going to get all the big returns, but if you've got the right investors, it sounds great.
Well, this is my core contention. My core contention is, in the venture universe, you need one huge unicorn winner to make up for 50 or 60 losers.
Yeah.
Right. So you need one company to basically return, 10x the fund, 20x the fund, that kind of thing, the amount that was invested, to make up for all these investments that are going to die. And the contention that I hear from venture investors and folks in that universe is, that's just the way it is. There's no chance that 40% or 50% of startups could possibly survive for 10 years.
Sure. Yeah.
It's just impossible.
Yeah.
And I don't think that's true at all. I think that's the dirty lie of the venture asset class, is that if they change the culture, the focus, the incentives, the model, the design, if you were to encourage founders to build profitable, long-lasting companies, you would get, at the very least, I believe you would get rates of survival that look more like restaurants, which restaurants in the United States are historically, super challenging business.
Yeah.
Only 55% survive 7 years or longer.
Mm-hmm. Yeah. Yeah.
55%.
Yeah.
That's so much bigger than
That's good.
any venture fund has ever seen their startup survive on average.
Yeah.
So this is my argument that if we can sort of build an example company with SparkToro and a few others, right? Been encouraging and trying to do a little bit of investing and, nudging other companies to do similar things. If we can have a few examples of that, I think more entrepreneurs will say, yeah, I want a lower risk, chiller lifestyle, higher odds of success business. And there's nothing to prevent those companies from becoming billion-dollar unicorns if that's what you want to be. Atlassian and MailChimp started as profitable, decade-long running companies before they ever raised venture and kind of went for the stars.
Yeah. Yes, interesting. So just in your spare time, you're changing the entire VC model as well. So
that's what I want to do. You have a bad experience with it. I think there's two kinds of people in the world, right? There's the people who, if they have success, they want to pull up the ladder behind them.
Yeah.
And there's people who, if they have success, they want to build an elevator.
Sure.
That's what I want to do. Build an elevator.
Yeah. Sounds great. Really, really encouraging. I'll follow along how you progress with that. I'm sure you do well, because as a business owner myself, it's just attractive. It's just a more attractive model than this kind of relentless pursuit of growth at all costs, including your health. Can we just spend a moment talking? One thing I found, again, on a personal basis, I know a lot of the audience in this podcast are interested. You've got this dynamic between what you refer to as a consulting business and sort of evolving towards a kind of tech or a product business. And you unpack some of the, just some calculations and numbers on that. And on the face of it, the kind of productized tech type business with investment and VC money looks to be doing so much better. And if they have an exit, if they have a sale or something like that, they think, oh, the numbers that are quoted are potentially huge. And then you begin to sort of delve down a level or two, and you think, well, actually, if you're just running your initial consulting business, you never scaled, you bootstrapped. Tell us a little bit more about that, and if you could recall some of the numbers or examples.
Yeah, absolutely. So I'll use a friend of mine runs a small consulting business. I think she's got seven employees, and her take home pay varies between about 150,000 in leaner years to around 400,000 or more in really good years, right? So she had a very good few years during COVID, and I think this year is a little bit lower, but it's the kind of business where her earnings fluctuate based on number of clients and what they're paying, and classic consulting, right? It's a little bit feast or famine, and it has its struggles, absolutely. But if you compare that to for example, her last 7 years of earnings running this very small remote consultancy to my first 7 years as CEO of a venture-backed startup, which grew from, I think, Moz was doing about 700,000 in software revenue when we first raised investment. Oh no, less than that, 450,000. Its first year, that's 2007. Grew to 40 million, about 40 million ARR when I stepped down as CEO, I guess 8 years later. So across those similar time spans, my consulting friend out-earned me by about 50%. Wow. Right? She made about 50% more in annual earnings than I did. My salary at Moz was not bad. I think in 2008, it was like $130,000, which I thought, as a kid, I thought that was incredible and amazing, right?
Great.
I was like, oh my God, I'm making six figures as a 29-year-old, 28-year-old. That was great. But I never made more than, I think my salary at the top end was about 200,000, 210, something like that. And that was kind of at the very end of my tenure, which also very nice salary, not complaining at all. But, looking around the Seattle area, I mean, software engineers were
Yeah,
making a lot more than that at
yeah,
Facebook and
yeah.
Amazon and Google and Apple. Even I was not the highest paid person at Moz. I think there were about 20 people who were making more than me, right? You know,
Yeah.
CTO that we'd recruited from here, CMO that we'd recruited from there, senior engineers who, you know, could make $250,000 at Google. So why would they come to Moz for any less? All that kind of stuff.
Yeah, yeah.
And your stock sits around, right? You own it, but it's not money, right?
It's not liquid.
It's net worth on paper.
Yeah, exactly.
Yeah, it's net worth on paper, but it is not. It's not money that you can use to go buy a very expensive sandwich in Seattle. So that's it's just a very
it's an interesting
dynamic.
But then you think, yes, but you've got this stock, and at some point you'll exit, and it'll be worth millions. So happy days. But then you sort of unpack the story of that as well, because as you raise more and more, your stock, the sort of percentage that you own of the business gets smaller and smaller. Versus your
higher and higher.
Yeah. Your consulting friend still owns 100% of the business. And the actual true valuation is tiny by comparison, but 100% of something can often be bigger than 10, 15% of something much, much bigger. And that's the other interesting thing.
If she sells her business for, you know, $1.5 million, that's $1.5 million that goes directly to her bank account after taxes, obviously.
Sure, yeah.
You know, if Moz sold for $50 million, I'd make about the same, right?
Yeah.
So,
yeah.
Not a great situation.
Yeah, so that's just interesting. And again, it's worth anyone listening to this just before. I just think it's possible to get caught up in the hype. I'll build this $50 million business, say, won't it be great? Well, maybe it will. And maybe you'll actually just work out the same as if you ran a consulting business for the same period of time. And actually, if you factor in the stress, the hassle, and all those other things going on, then I'm not trying to put people off in any way. If you've got this sort of this entrepreneurial itch you want to scratch, then go after it for certain. But, and again, the great thing about the book and a lot of your other content that you write is just go in with your eyes wide open, because it is just it's dangerous. You know, this treacherous territory, and go in knowing what the upside, knowing what the downside is, knowing that the odds are actually stacked very much against you. But if you're up for it, you know, go for it. But
I think that I am not an anti-venture person. I think that asset class should exist. I think it should probably fund about 1/10 the number of businesses that it does currently. But if you're trying to build a new, you know, create a new pharmaceutical or invest in biotech or clean energy or regenerative agriculture, you need a massive amount of capital before you're ever going to produce anything. And it's wonderful that the venture asset class exists to take those kinds of risks. I actually have a friend at a company called Veda, which does regenerative agriculture. They do like soil sample monitoring, and you know, they have all these incredible results with the farms that they work with. And hopefully it's going to scale out to a lot more farms in the US and around the world. It's wonderful. It's fantastic tech. He loves the job. The company's really cool. Couldn't exist without hundreds of millions of dollars of investment prior to you know, sort of getting out in the market. But SparkToro and many companies like them, which go out and try to raise venture, probably can get off the ground for $500,000 or less. And probably can get to profitability over the course of a few years and sit on those profits and earn those profits and use that profitability to sort of run a very careful, structured business, and not try to, you know, well, we made $2 million last year. We better make 10 this year. You don't need to, right? You can focus on delighting your customers, serving your employees well, having a great life, having a profitable business, returning money to your investors. So I was going to share, Alan, because I think in the interest of full disclosure, it's just right to share it. 2021, I get a call. I'm no longer on the board of directors. You know, I've been out of Moz for 3 years entirely, but I get a call from one of our, my old lead investor, and he says, "Hey, we're selling the company. Like, we've decided we're going to sell the company. You're going to have to sign some paperwork in about a month." And I didn't really believe him. I thought, yeah, sure. I've heard this one before, right? We'd had multiple attempts to sell the company. But it did happen. So June of 2021, Moz sold. I'm not allowed. I had to sign paperwork saying I would not disclose the sale amount. But thankfully, the company that bought it is a publicly traded Canadian private equity firm. So they have to disclose how much they spend on acquisitions each quarter. They only bought 2 companies in the quarter that they bought Moz. So Moz and like one other very, very small website. I think people would be generally shocked if they paid, $5 or $10 million for that.
Right.
But maybe they did. Who knows? But the total amount that they spent on those 2 acquisitions was about $90 million.
Right.
So Moz was doing north of $50 million in software revenue. And obviously this company that bought them must have paid less than $90 million to buy it. That is a similar multiplier. If you assume that they spent nothing on the other business, that is a similar multiplier to a consulting firm.
That's under 2 times revenue.
Under 2x revenue. That's exactly right. And Moz is a business whose margins were north of 85%.
Wow.
Right? So just an incredible business, but the valuation is based so much on growth. And Moz's growth rate was near zero. It was like 2% or something. Right. At least the last time I got to see the financials, which was, before I left the board. It was growing at like 1.8% year over year, right? It's just very, very anemic growth. That valuation, because nobody wants a shrinking or plateauing business, was very, very small. And of course, the venture investors have what's called participating preferred shares. For anyone who's not familiar with venture world, this is extremely common, where they essentially get their money back before the calculations are done for everything else, right? So if our investors had put in, I think 35-ish million, so they get their 35 million, and then it's calculated what does everybody else get on the percent of. And
that's actually a relatively generous model that you had from a VC. Sometimes they had 2x times. They had to get 70 million before anyone get anything. Then distributions after this. So it's when you start digging into the numbers and the maths around this stuff, you begin to realize, hang on, it's not quite all it's cracked up to be. You've been very public about the offer, many years before this, that HubSpot made to you, and you were pretty close to them. And again, you document it in the book as well.
They still tease me about it.
You've stopped smiling about it. No, you're probably smiling about it again because it was a while ago.
I'm smiling about it again because I have a really wonderful life and great business.
But there's an interesting dynamic here. It kind of fascinates me a lot in life in general and in my day job, and it kind of comes under this concept like how much is enough. They made you, I can't remember the numbers, but it was a big number. It was and you had investors 40 million, and you were going to walk away with, I think, about 8. Is that right? 8 or 10 or something like that.
Somewhere around 10.
It was a material sum of money, which to the vast majority of the population is life-changing and it kind of never need to work again, financial independence, blah, blah. So, with the benefit of hindsight looking back, that was enough and you should have taken it with both hands. But it was undervalued. It was undervalued by your definition and your investors.
Right. The real rub is that a large portion of that would have been pre-IPO HubSpot stock.
Right.
Right. So HubSpot's pre-IPO stock in 2011 would probably have meant that Moz actually sold for $250 million. Right.
I'm glad you're laughing.
Shoot.
Yeah. Okay. Whoops.
I mean, what's $100 million between friends?
Come on, it's nothing.
Yeah,
I guess the thing is, you weren't.
Harmesh can buy me dinner.
Yeah, for sure, for the rest of your life. He's so. But I guess the thing there is that's more uncertainty. No one was to know. HubSpot was a great business, still is a great business, but it wasn't certain that the IPO would fly and all that. But so there's a lot of risk, and I guess those are the challenges, aren't you? You made an offer, and you think, well, we could take it now, and if it all worked out, it would be amazing. But you've also got your own belief in your future growth, and it's a huge trade-off. No, I don't think anyone could ever blame you. I think if anyone's, you probably blamed yourself somewhat and you've regretted the decision and over times. But obviously, hindsight is a very precise science. It could have gone the other way and you could have sold out for a cheap price and it wouldn't have worked out. But
I think that the logic that I had at the time, which is foolish sort of, young man hyper confidence
Sure.
was I looked at the sale price and I looked at our revenue. I think Moz was doing $11 million a year. We were growing, year over year, 2x. 2 years later, we would be a little over 30 million.
Yeah.
And I was like, gosh, selling for 40 2 years before, like, that's how much revenue we're doing.
Yeah.
I can't, it doesn't make sense. Like I think we need a bigger number.
Yeah.
So I went to them and I said, hey, you guys got to get over, I might've said you have to get over 45 or something.
Yeah.
And they were like, we can't get to, I want to say they were more in the 35 range.
Right.
Like, anyway,
Yeah.
we were about
Just
$10 million
couldn't
off.
Yeah.
It ended up not working out. They were total gentlemen about it. Brian and Dharmesh were, and continued to be supportive and sweet and kind to me and Moz for years to come. But yeah, it would have been
It's quite interesting. Yeah, I mean, there's so many lessons there to anyone growing a business who does get an offer, come in and negotiate it. That sometimes you should take it, sometimes you should think it through, and but then it comes back to
my argument generally, Alan, is if an offer comes through, even if it's not all the way there, and you personally and sort of your team are generally not financially well off, I would urge you to take that, right?
Yeah.
Get that one kind of win, that life-changing money, the ability, when I look back on those years, the ability to spend a few extra tens of thousands of dollars to help out my grandparents, help out some of Geraldine's family, get a house in the Seattle market before it went crazy, help out some friends, invest in some of their projects. It would have been, I don't want to beat myself up about it, but there are real tears of regret that I have about the 10 years of sort of not having the money to do those kinds of things and help out the people that I love and care about. That sucks, and the stress of feeling like when I left Moz in 2018, when I left Moz, we had $375,000 in savings or so, which is not terrible. It's better than a ton of Americans. Like, I don't want to make it out like, oh, we're poor and broke or whatever. But we've got a mortgage, we've got healthcare to cover, and so I started SparkToro the day after I left Moz.
Yeah,
I didn't
take a long vacation or anything. No. Back to work.
It was like, oh my God, we need, we got to get healthcare right away, right? Because coverage in the US is so finicky, and we had to, I had to get started on getting a salary again, and
I think, in my view, having worked with a number of entrepreneurs over the years, is trying to define, and it's a number you arrive at. What is the cost of our ideal lifestyle, including helping people around us that we care about? Kind of revert. There's a calculation you can reverse engineer that and say, look, if we got whatever, it's different to everybody, 5 million, 10 million, 20, 50 million, whatever it is, if we ever got that number, that's enough. More is better. More can be better, but that is it. That is enough. And if someone comes in and offers that or more, then you should probably. I've got a view that it is. And again, this is the benefit of experience and getting older and reading amazing books like yours. But I have this view that it's kind of the responsibility of an entrepreneur to create economic security for their family. And all this sort of growing a business is fabulous, but it's fragile, as we know, and it can change quite quickly. So sometimes it's just like, I'll cash in now and maybe go again later in a different style. But
absolutely, I think this is the other thing that scared the crap out of me. I was so in my head about it for probably the last 18 months that I was at Moz. I was so scared that was my one idea. Right. That I would never be able to come up with something great again and build another company. And, when I thought about the challenge of it, it just seemed overwhelming. And I also felt like I had to prove myself to me and to, my board of directors and people who thought I was wrong about the company. And that, that stress was overwhelming. So I have a lot of empathy for that. I have a lot of empathy for folks who, are going through tough financial times while doing the entrepreneurial thing. And I would say, I think those early exits can be amazing. The one thing that's weird is, as a venture-backed company, it's probably a really good idea to do that. As a non-venture-backed company, right? So SparkToro, we got an offer. I don't know how totally serious it was. We didn't pursue it to its, complete end, but we got an offer for the company, what was that, 18 months ago? And, Casey and I kind of looked at each other and said, well, we're about to pay our investors back. And then we're going to be paying dividends to all of the owners, ourselves included.
Yeah.
I kind of would rather run this amazing, French working hour business for 10 years and see where it goes and take the dividends from that rather than selling it. And then
for sure, it's a different mindset. You don't have, it feels to me, you don't have that external pressure, regardless if you want to be successful, but on your terms, with your aligned to your chosen lifestyle. I think that's an important thing. When you're running a business, it's not like a 9-to-5 job. It is your life. It's one way or another. It's a 24/7.
Yeah, one way or another, right? And I think that's okay. I enjoy it. I love
exactly.
Sparktoro and all the things that it gets to do. I love Snack Bar, right? The video game studio. Like these are beautiful things. I get to work with people I love and care about. I hopefully get to create economic security for them too in the future. I solve interesting problems, have fun doing it. I think work can be really fulfilling.
It's fabulous, but I sense that you don't have that external pressure of hitting numbers every quarter, getting called into a board meeting and being shamed over you not growing at 100% a year or something like that. Because
Casey probably doesn't want me to say it, but Sparktoro since April of this year has had basically 6 months. Well, we had 1 month where we grew, but like 6 months where we kind of trended down, right? We went from, doing whatever our MRR was to about 20% less than that, because largely driven by this Twitter Elon problem, right? Until we get this new version out, which is happening next week, we're not going to be in that position to grow again. And still, we got our message from our accountant last week, and in October, we still put 40 grand in the bank.
Nice.
Right? Profit.
Then the thing that it strikes me, if you had 6 months of downtrending revenues at Moz at the time, it would just have been so damn stressful. Wouldn't it just be awful? Yeah.
I can't even imagine. It's really, Casey and I have had calls about it where we go, last month was down. I'm feeling pretty good though. It wasn't down that much.
It's so refreshing. It's nice.
The new product looks great. It's wonderful to be able to focus on the product, the customers, the team, the things that you care about, as opposed to sort of what an external party who doesn't share your incentives and doesn't share your customers' incentives. I think that's really hard, right? Because, our investors at Moz, their goal was not let's delight Moz's customers. No. Let's make them happier month after month. Their goal was how do we get to these very large outcomes, even if that means screwing over the existing customer base.
Sure.
And you can feel that. I think Cory Doctorow wrote this great post where he called it the inidification of the internet.
Right.
Where essentially, a business like Google starts out serving its customers really well, its core customers, then serving its advertisers really well. And then it screws both of them to get gains and growth beyond that.
Sure.
And, every business, Amazon is like that, right? Twitter is like that. Facebook is like that. Reddit is like that. It just kind of sucks.
And that's the challenge. If you got two groups of people, like the original people at Moz and the founders and you are still dedicated to the core values that you started with, and you've got these other people who are your business partners, you share the same aligned sort of aspirations in terms of we want to grow this business, want to make it a success. But how you do that, I'm guessing, is different. They're kind of like, I don't care, just make some money and grow. And you'll say, but we want to do it well. We want to do it with integrity and honesty throughout. And it gets to a point. I'm not trying to decry all the VCs in the world, but it's like, just screw that. Just make us more money. I think this is a great point, just to pivot slightly into this idea, because one thing from following your story, Rand, is one thing that stayed true throughout Moz and now into Sparktoro is the concept of values in a business, core values, what you think about how you operate. Because it was a big thing at Moz, wasn't it?
Yeah,
tag fee, if I remember correctly.
That's right.
But you've got your own versions of that. So just share with us, if you will, your thoughts on the importance of values, documented values within a business.
Yeah, I think this is part of my, when we first started this conversation, Alan, we talked about that designing your business sort of strategically and in a structure that makes sense for you, your team, your customers, all that kind of stuff, the life that you want to build. And for me, values are a part of that, right? It's essentially saying, I recognize that there are things that are more important to me than making more money.
Mm-hmm.
And rather than having those conversations one off each time a potential conflict comes up, or a challenge, or
Mm-hmm.
an offer or whatever,
Mm-hmm.
we are going to document what those values and beliefs are that we would not exchange for more money. And when we list that out, we're going to use that in the future like a roadmap or an architectural diagram to make these decisions. And so, at Moz, we had this thing called TAG fee, which is essentially an acronym
Mm-hmm.
for the values that we had: transparency, authenticity, generosity. At SparkToro, we have them again. It's called Belux.
Mm-hmm.
And folks can Google it if they want.
Sure.
BELUX, SparkToro. We'll show you that post and sort of the things that we believe in. But what I'm not suggesting is you should adopt my values.
No,
That's
sure.
not what I'm
Definitely
saying,
not.
right?
No.
What I am saying is, if you have things you would not trade for money, write them down now, right? Get them to all the people in your company, agree on them with your partners, with yourself, right? With your team. Maybe even put them out there for your customers and your community to judge you against, so that you hold yourself accountable in the future to those things when they come into conflict with making more money. And if you don't have them, if your entire goal is like, hey, I would murder someone for money, like, okay, great, fine. Just put that out there as well, so that you can recruit the kinds of mercenaries, right? Who would do anything for money. No offense. Well, some offense intended, but Goldman Sachs, right, is clearly will do anything for money, right?
Sure. Yeah. And they're not the only one. And that's fine within reason. And if you want to work for Goldman Sachs and you know that, have fun. Go.
Yeah. I mean, there's plenty of finance bros in New York who, I've seen out at the bars, and I'm like, oh, yep, you'll do anything for money. Got it.
Yeah.
Right. And that's not my kind of person, right? And that's not, I don't want to work with those people. I'm not particularly excited about helping them. But what's great is doing it beforehand. This is also true in your co-founder agreement.
Yeah.
So when Casey and I started this business, right, we got together for coffee and lunch a bunch of times and talked through a ton of scenarios where things go really well or really terribly at SparkToro.
Yeah.
And what are we going to do? How are we going to react? And by writing those things down beforehand, whenever any of them happened, you know what? We already had a documented design for how we were going to behave. Yeah. And so we knew what to expect of ourselves and each other. That is so powerful. It avoids so many terrible arguments and fights, the kind that I had all the time at Moz, especially after I stepped down. I wish I had done that same thing. I can't encourage people enough to have those conversations before the hard things happen. It's kind of like a marriage. Yeah. Right?
It's a prenup, isn't it? Yeah.
Yeah. Do we want to have kids? Do we share the same values? Do we have similar politics? What do we think about religion? What do we think about family and spending time with them? What are we going to do on holidays? How are we going to spend our money? Like all those really important conversations you would have with a romantic partner. Yeah. You should have with your business partners too.
I couldn't agree more. And you learned that along your journey because you didn't have that to the same degree at Moz, and it caused friction. Not only that, it's mental energy and takes time, because then you've got to solve every problem as they arise, and it's just soul destroying. So now we say, what is our agreed? And the great thing about that, you make that agreement in like the cold light of day without any emotional attachment. Sometimes things blow up. And say, well, let's just go and see when we were all sort of fine and in the restaurant or whatever. This is what we agreed rationally. This is, we're still good for that. I think it's so important, and I would recommend anyone's listening to this, if you're going to start a business, then do follow that. And if you're already in business and you haven't got that, go back and spend some time. It does, of course, it takes time to create it, but it saves a hell of a lot of time and energy and fighting and all the rest of it down the line. It's a great piece of advice.
I can't encourage folks enough. I think that agreement beforehand is just a beautiful thing. And I would say too, it forces you yourself, even if you're a solo operator, if you can write those things down, it forces you yourself to consider these important structural, strategic elements for your life ahead. I was helping out an entrepreneur who runs an events business in the UK last week, just before American Thanksgiving. And I was talking to her, and she's, I think she hadn't asked herself a lot of these hard questions early on, but when she did, she got more excited about her company, right? Yeah. She was like, oh, yes, this is what I want to do with my life. And this is what I don't want to do.
Yeah. It's a great reflective process to go through. We've done it here in my firm, and another important point, it enables you to make the decisions without as you've already alluded to. Somebody that might come and join our firm, and you meet them a couple of times and say they just everything they did and said doesn't fit with that. So not only would they be bad for us, they'd be bad for them as well. They'd just be a fish out of water here. So there's no point in having them here. So, but you'd be a great fit somewhere else. So it's just creating that decision-making framework in advance.
Having shared values and strategy and agreement among the entire team means everyone is working in the same direction all the time.
Exactly.
And that is not just more productive, but it is more fun and rewarding to be in that environment versus having those fights over and over again with people who fundamentally at the core values level disagree with you about, whatever the direction of the business, how to serve customers, what to do for money and not, all of those things. So, we have, I'll give a real tangible example because I think that'll help. So at SparkToro, one of the things that we really believe in is helping small and medium businesses and not necessarily large ones. So big company reaches out, they say, hey, we want an enterprise package with SparkToro, but we need some support and we'd like you to fill out these, security compliance forms and we need like sort of these things. And they're, it's nice, right? They're offering thousands, tens of thousands of dollars. They're going to buy a subscription and it could really help the monthly MRR growth. And we just say, no, sorry, you can sign up for the packages online. We don't provide any extra support beyond that. We don't, we're just a tiny team of 3. We do not do, we don't have a sales rep we can assign to you. We don't do demos. We won't make a custom package for you. We won't fill out your security compliance. And yes, that means we lose at least 2 or 3 big potential customers every month.
Right.
And we are fine with that because it lets us structure our labor in the way that we want to, which is serving a broader group of people better, focusing on the product and the marketing and the content and all that kind of stuff, and not distracting us from that.
And it makes so much sense. You made those decisions up front. Had you not, then you might have spent countless hours saying, well, should we just take this one because it's a big client? It could be good.
Oh my gosh, this is such it's such a blue chip.
And our numbers have been down the last quarter, so we need to get the number. All that stuff. You just can't. It will then break the core values. And you'd be struggling to work French hours after that, taking on some of these big corporate clients. Look, I'm conscious that we need to sort of shoot off in a few moments. I just want to ask you a couple of brief things before we wrap up, Rand, if you don't mind. One thing that's been consistent throughout your entrepreneurial journey is you share a lot of it. You're very candid. You share a lot of your stories. As I've already mentioned, there's there's data, there's financials, etc. And I don't know what the best word is. Is it content? Is it this kind of the idea of personal brand as it pertains to entrepreneurs and business builders? And so you've certainly made that a success from where I'm seeing it, from watching your journey. What is your advice or what are your thoughts on building personal brand and sharing content for any other entrepreneur?
I think it's right for some people, but certainly not for everyone.
Okay.
And I have noticed even with my own behavior, I think my goals have very much shifted around it. Many of the years I was at Moz, it was absolutely about building the company's brand. And then later, as I realized I was going to be kind of pushed out, my personal brand as well, right? So that I could carry that with me and get started with something new. And I think I have talked to a lot of founders and entrepreneurs who don't feel comfortable with it. And I don't think that any marketing technique or any brand building technique is right for you unless you personally enjoy it. If you don't love it and get value from it and sort of feel that it's its own reward, you're never going to be great, right? You're never going to be fantastic at it. And I would urge you to invest your time in other places, right? Get better at recruiting people, get better at outsourcing, get better at product development, whatever it is that you're great at, go pursue those things. I happen to really enjoy teaching people. I love sort of the culture of sharing. And so that transparency is a part of who I am. And I had really bad early experiences, both family and business, of keeping secrets. I hated that crap. And so I don't want there to be any, skeletons in my closet that someone could find. Right. So I just open my closet all the time.
Sure.
just keep it open. And that works well for me, but it's not for everyone.
Yeah, so it's a great point, because a lot of people are saying, yes, all these CEOs and founders, you got to start write content, create stuff, create videos, start a podcast, etc. And the answer is, as you say, is maybe if you like it, and you're good at it, and you can learn to be good at it. But some people just don't like it. So as you say, that makes sense.
Yeah, invest in places where you have passion and interest, because it will carry you through. You'll be better at those. And having the economy is so big. Yeah, it's so big, Alan. There's so many billions of people out there. You don't have to do what person on TikTok or LinkedIn or YouTube is doing. You can do your thing really well.
And I think that's kind of the underlying theme to this entire conversation, which, by the way, I've enjoyed a lot, which is don't necessarily believe just what, the magazines or the website, whether it's raising capital through VCs or otherwise, whether sort of unicorn Silicon Valley is as good as it's cracked up to be, or whether you should build your own personal brand and write blogs every day. And the answer is it works some places, but not for everyone. And some people would have us believe everyone should be doing these things. Everyone should be doing all this stuff. And it's so not true.
I think it's very compelling and powerful to get on a video and say, everyone should do this. Yeah. Look at how much success I had doing this. Yeah. And it's not the truth. Right. And I think anyone who's followed folks who are self-aggrandizing and who build those cults of personality recognize that is in their self-interest, not in yours.
Exactly. And it's that I would imagine it's actually quite depressing to see somebody who's got millions of YouTube followers saying anyone can do it. I started with no followers at all. Now I've got millions. And then, 3 years later, someone's still got 6 followers. It's quite depressing to do that. So, yeah.
And a lot of the time, right. So many people have, for example, years ago pointed to my Twitter account and said like, oh my God, how did Rand Fishkin get 500,000 Twitter followers? Yeah. You know what? A big part of it was I joined Twitter very early. Yeah. And then as lots of other people in marketing joined Twitter, I was recommended to them because I was one of the early people in there. So it wasn't that I did this genius thing other than I rode the wave of people joining. Geraldine, my wife, did the same thing with Threads. She was active early on Threads. Now she has tens of thousands of followers on there. She's building a big name for herself. Wonderful, right? Amazing. But I hope that in 5 years, no one looks at it and goes, "Oh yeah, wow, we can all do that."
Well, you make the point very well in a lot of your writings that a big part of success, a huge part, is luck, and it is right place, right time. You're early on Twitter. I mean, your writings are fabulous anyway, but it's part of the story. There's other people who write very well, but they're kind of new to it, and so therefore they haven't built a following yet. So, combination of a number of different factors. It's not just I'm fabulous at Twitter or X. It's a combination.
If you jump into AI thought leadership today, you're 2 years behind.
Yeah,
right?
Exactly.
3 years behind.
Yeah.
Too late.
You're late. Rand, thank you so much. Just before we wrap up, I do want to ask you, I mean, first of all, I've been sort of talking about it through this entire conversation, so you can tell I'm passionate about your book. I know it's been out for a couple of years, but it's still, anyone who hasn't picked it up, Lost and Found in all good bookstores. But other than that, any thoughts on resources that you would recommend for other entrepreneurs, books, podcasts, anything that would be helpful to others on their journey?
Oh, gosh. Absolutely, yes. I mean, I have as you can see, a giant bookshelf.
Yeah, just turn around and you look at your books.
Lots of content that's almost exclusively entrepreneurship and marketing focused, and helping people build better businesses. Let's see, if I had to call one out, I really love what Liz Fosslien and Molly West Duffy did. They have 2 books. Here, I'll grab them. So these 2 are Big Feelings and No Hard Feelings. Both of them are just excellent. Really? Okay. It's sort of about bringing your emotions to work, handling emotions at work, having those kinds of agreements and discussions that we talked about before things get out of control. I love both these books, and Liz actually joined our Spark Together event last year and
Great.
spoke about the process of putting these together, and fascinating, right?
What
So
wonderful.
extremely
Thank you.
accomplished, and I love their content. They also do, it's really wonderful. They do a lot of these like little, visual
Yeah, I love it. I
graphics
love it.
and cartoons, right? To help break up the book and make it
Yeah.
more accessible. So I find
That
these
looks like a
just
great book.
delightful.
I hadn't heard of them before, which is unusual. I read a lot of entrepreneur books. I'll look those up, and I'll put a link to both those books in the show notes. And if anyone is listening to this and watching this, they can go and find out about those books. So a recommendation from you is it's a great endorsement. So people should pick them up. Rand, thank you so much. The very last question I'm going to throw at you, take a second to think about it and reply. All the roller coaster you've had, the ups and downs, the money, the not money, the experiences, the joys, the challenges. There was a lot of other things we could have talked about, but maybe on another opportunity, we might do that in the future. But in the short term, I think about wealth, the concept of wealth, and I want to ask you, what's your definition of true wealth?
I mean, let's see. When I think about financial wealth, I think of it, I think quite differently than many folks do, which is that it is a tool to be used to create the life that you want to live and to help create the world that you want future people to live in.
Mm-hmm.
And I think, for me, at least for me personally, my goal with wealth is to, I now have my basic needs met,
Mm-hmm.
right? I have a nice amount set aside for retirement, and we have, I have a nice salary from SparkToro. Geraldine makes good money from her books.
Mm-hmm.
So my goal financially and wealth now is build the relationships with people that I care about, get to spend time with them, and get to help them financially and otherwise to create that future world that I want to see.
That's fabulous. That's a very grand vision of wealth. It's not just what's
I mean,
interesting.
It's small scale, right?
But what you said. Once you take care of, it's almost like Maslow's hierarchy, isn't it? Once you take care of you, it sounds to me that you're okay financially. Things are in good shape.
Yeah.
So then it's the next definition. What's the kind of the second or third order impact or effects that wealth can have? And I think you made a very good point. It's not necessarily financial. It's not necessarily money. Wealth doesn't mean money. It means a lot of other things.
It does. I mean, I would say I'm very much driven by friendships and the love and care that I get to have with people around me. I prioritize that over financial wealth quite a bit.
Yeah.
Right. So that
wonderful.
I think that's always going to be true. And also, I don't mean to minimize the importance of financial wealth, because that's what enables those things.
Absolutely right. Well, I can tell you, Rand, you've made a few new friends over here in the UK now as a result of this conversation. I really appreciate the time that you spared to talk to us today. It's been invaluable. As I've mentioned several times before in our conversation, anyone should go out and buy your book immediately. Follow your blogs, follow you on Twitter. I'll put links to all these various things in our show notes. But for now, Rand Fishkin, thank you very much.
My pleasure, Alan. Thank you for having me.